You're about to buy your first index fund. You open Vanguard, two options, VTSAX, VTI. Same holdings, same company. One costs $3,000 to start, the other costs $250. You freeze. Which one is actually better? Here's what nobody tells you. You're asking the wrong question, and that mistake is costing you thousands in opportunity cost while you sit there paralyzed, doing nothing. By the end of this video, you'll know exactly which one to buy and why most investors get this backwards. Let me show you what's actually happening. You've done your research, you know passive investing works, you know index funds beat most active managers. You're ready to start. Then you see it. Index fund, ETF. Both track the same index, same expense ratio, same returns on paper. So you start Googling index fund versus ETF. 50 articles, all saying slightly different things. Tax efficiency, intraday trading, fractional shares, NAV versus market price. Your brain starts spinning. You close the tab, you tell yourself you'll figure it out later. 3 months pass, you've done nothing. The market is up 12%. You missed it. Not because you didn't have the money, not because you didn't know what to invest in, but because you couldn't decide between two nearly identical products. This is the real cost nobody talks about. Analysis paralysis isn't just annoying, it's expensive. Every day you wait is a day you're not compounding. And here's the worst part. The difference between the two barely matters, but the difference between investing and not investing, that matters enormously. Here's why this happens. The financial industry has an incentive to make things sound complicated. Complicated sells. Complicated makes you feel like you need experts. Complicated keeps you watching videos, reading articles, paying for advice. So they give you 20 variables to consider. Bid-ask spreads, premium to NAV, wash sale rules, tax loss harvesting strategies, trading windows. Most of this is irrelevant for 95% of investors, but you don't know that yet. So you treat every variable like it matters equally. You give the same mental weight to tax efficiency, which might save you $30 a year, as you do to actually starting to invest, which could make you $30,000 over a decade. This is what psychologists call the paradox of choice. More options don't make you better off, they make you freeze. And the financial media knows this. That's why every article gives you 8 considerations, 5 pros and cons, 3 scenarios where one is better. They never just tell you what to do, because if they did, you'd stop reading. But I'm going to tell you what to do. Not yet, though. First, you need to understand why the conventional advice is designed to confuse you. Let's break down what people actually say matters. ETFs are more tax efficient. Okay, for who? If you're investing in a Roth IRA or 401k, taxes don't matter at all. That's 70% of your investing right there. Irrelevant. Index funds let you buy fractional shares. True. Does it matter? Only if you're investing small amounts frequently. And even then, most brokers now offer fractional ETF shares anyway. ETFs trade throughout the day. Correct. Do you need to trade throughout the day? No, you're buying and holding for 30 years. Intraday pricing is a feature you'll never use. It's like buying a sports car for your grocery runs. Index funds have minimum investments. VTSAX requires $3,000. VTI requires the price of 1 share. If you don't have $3,000, the choice is made for you. If you do have $3,000, this isn't actually a meaningful difference. See what's happening? Every difference sounds important in isolation, but when you apply it to your actual situation, most of them vanish. The real question isn't which is better. The real question is which differences actually affect your returns over 30 years. And the answer is shocking. Almost none of them. Let me show you what actually matters. You have $5,000 to invest. You're 28 years old. You're trying to decide between VTSAX and VTI. Scenario 1, you spend 3 months researching. You read every article, you watch every video. You finally choose one, you invest. The market went up 8% during those 3 months. You missed $400 in gains. Scenario 2, you flip a coin. Heads is VTSAX, tails is VTI. You invest immediately. 3 months later, you have $400 more than scenario 1. Now extend this. You're not just making this decision once, you're making it every time something feels uncertain. Which ETF, which allocation, which broker, which account type.
Each decision takes time. Each delay has a cost. The cost compounds. This is the difference between people who build wealth and people who study building wealth. Action beats analysis, especially when both options are nearly identical. But here's where it gets interesting. There is a right answer, not because one product is better, but because one choice is better for your specific situation. And most people never figure out their situation. They're too busy comparing products. Here's what's really happening in your brain. You're not actually confused about index funds versus ETFs. You're afraid of making the wrong choice. Loss aversion. It's one of the most powerful forces in investing. The pain of losing money feels twice as strong as the pleasure of gaining it. So when you see two options, your brain doesn't think which is better, it thinks which is safer. And when both seem equally safe, it freezes, because doing nothing feels safer than potentially doing something wrong. This is why people procrastinate on investing, but not on buying a phone. With a phone, you can see the features, you can hold it, you can return it. The choice feels concrete. With investing, it's abstract. You're choosing between two ticker symbols that both say total stock market. Your brain has nothing to grab onto, so it keeps searching for more information, hoping that eventually the right answer will become obvious. It never does, because there isn't a dramatically right answer. There's just action versus inaction. And here's the cruel irony. The people who agonize over this decision the most are the people who care the most about doing it right. They're conscientious, they're careful, they're trying to optimize. But optimization without action is just procrastination with better branding. Now add social media to the mix. You finally choose one. You buy VTI. You feel good. Then you see someone online saying VTSAX is better because of automatic investing. Now you feel stupid. Next week, someone else says ETFs are better because you can move them between brokers. Now you're second-guessing yourself again. This is the comparison trap, and it's poison for long-term investors. Because here's the truth. Both people are right. VTSAX is better for automatic investing. VTI is better for portability. They're both correct, and both differences are almost completely irrelevant to your 30-year returns. But your brain doesn't know that. It just knows you chose one thing and someone else is saying the other thing is better. So now you feel behind. You feel like you're missing out. This is FOMO applied to investing, and it's everywhere. Reddit threads with 50 comments debating Vanguard versus Fidelity, YouTube videos comparing expense ratios that differ by 0.01%, Twitter arguments about tax loss harvesting strategies that save $14 a year. It's all noise, but it feels like signal, because everyone's talking about it with such conviction. Here's how you know it's noise. Look at what wealthy people actually do, not what they say, what they do. They pick something reasonable, they invest consistently, they ignore the rest. They're not on Reddit debating fractional shares. They're not watching comparison videos. They made a choice 5 years ago, and they've been compounding since. The irony is that the people obsessing over these tiny differences are usually the ones with the least money invested, because they're still at step one, still choosing, still analyzing. So here's where we are. You know the differences don't matter much. You know waiting has a real cost. You know your brain is wired to overthink this, but you still don't know which one to actually buy. And that's intentional, because the answer isn't about the products, it's about your behavior. Let me ask you something. Do you want to set up automatic monthly investments and never think about it again, or do you want the flexibility to buy whenever you want, move money between brokers, and maintain control? That's not a product question, that's a personality question. Some people need automation. Without it, they won't invest. They'll intend to, but life will get in the way. Automation removes willpower from the equation. Other people hate being locked in. They need to feel in control. Automation feels constraining. They'll actually invest more if they maintain flexibility. Neither is better, but one is you.
And here's what nobody explains. This matters more than tax efficiency, more than expense ratios, more than any technical difference. Because the best investment strategy is the one you'll actually follow, not the one that's theoretically optimal, the one you'll stick with for 30 years. But there's still something missing, something that determines whether you should buy the $3,000 version or the $250 version. Something about liquidity and dollar-cost averaging that everyone gets backwards. And that's what we're covering next. Because once you understand this, the decision becomes automatic.
you'll know instantly which one is right for you, not because I told you, but because the answer will be obvious. But first, if you're finding this valuable, hit the like button. It tells YouTube to show this to more people who are stuck in this analysis paralysis. And drop a comment telling me which one you're leaning toward right now, VTSAX or VTI. I read every comment. Now, let's talk about what actually determines your choice.
Here's the framework nobody gives you. Ask yourself, will you actually log in and manually invest every month? Be honest, not aspirational, honest. Most people say yes, most people don't. Life happens, you get busy, you forget, the market drops, and suddenly investing feels scary. You tell yourself you'll do it next week. Next week becomes next month. This is why automatic investment plans exist, not because people are lazy, because human psychology is predictable. Index funds like VTSAX are built for automation. You set it once, money leaves your account every month, buys fractional shares, you never see it, you never think about it, it just happens. This is a feature, not a bug. It removes decision-making from the equation. ETFs like VTI require manual action. You have to log in, decide how much to invest, click buy. It's not hard, but it's friction, and friction kills consistency. Here's the data. Investors who automate their contributions invest 63% more over 10 years than investors who do it manually. Same income, same intentions, different systems. The automated investors aren't smarter, they're not more disciplined, they just remove the decision from their future selves. So, first question, do you need automation to actually follow through? If yes, you need an index fund. If no, keep listening. Second question, how much are you investing right now? Not how much you plan to invest, how much do you actually have ready to deploy? If it's less than $3,000, the choice is made. VTI. You can't buy VTSAX yet. But here's what's interesting. That minimum isn't a bug either. It's a filter. Vanguard created that minimum to attract long-term investors. People who have $3,000 saved are statistically more likely to stay invested. They're past the impulsive stage. They've already demonstrated patience. It's not about the money, it's about the signal. Having $3,000 to invest means you've already won half the battle. You've delayed gratification. You've built a cushion. You're ready. But let's say you have $500. You want to start now. VTI is your answer. One share, you're in the market, you're compounding. Then next month, you add more. Month after that, more. Your position grows. Now here's where people get confused. They think if I buy VTI now, I'm locked in. I can't switch to VTSAX. Wrong. You can do both. Buy VTI until you hit $3,000, then convert to VTSAX and automate. Or don't convert. Keep buying VTI. Both paths work. The mistake is waiting until you have $3,000 to start investing at all. That's 6 months of zero compounding while you save. That's the real cost. Third question, are you absolutely certain you'll stay with this broker forever? Because here's something most people don't think about. Index funds are captive. VTSAX only exists at Vanguard. If you want to move to Fidelity or Schwab, you have to sell VTSAX and buy their equivalent. That's a taxable event if it's in a brokerage account. ETFs are portable. VTI exists everywhere. You can transfer it between brokers without selling. No taxes, no friction. Now, in a Roth IRA or 401k, this doesn't matter. Taxes aren't an issue. But in a taxable brokerage account, portability matters. Here's why. Brokers compete on features. Today, Vanguard might be best. In 5 years, maybe Fidelity has better tools, or Schwab has better customer service, or a new broker emerges with zero fees and better automation. If you're in VTSAX, you're stuck. Moving costs money. If you're in VTI, you just transfer, no consequences. This is the hidden cost of index funds, not the expense ratio, the switching cost. But here's the counterargument. If you're constantly switching brokers, you're probably not focused on the right things. Wealthy investors pick a broker and stay there for decades. So this only matters if you genuinely think you might need to move. New job with a different 401k provider, moving countries, specific tax situation. For most people, this is theoretical, but for some, it's the deciding factor. Now we're getting to the real difference. Some investors need to feel in control. They want to see the price. They want to choose when to buy. They want the flexibility to act.
These people hate automation. It feels like giving up control, like the system is making decisions for them. If this is you, VTI is your answer because you'll actually use it. You'll log in regularly, you'll invest consistently because you want to, not because you have to. Other investors hate making decisions. Every choice feels like a burden. They want systems that run without them. These people love automation. It feels like relief, like they set it up correctly once and now it just works. If this is you, VTSAX is your answer because you'll actually follow through. You won't forget, you won't skip months. Neither personality is better, but pretending you're one when you're really the other is how you fail. I've seen control-oriented investors set up automation and then obsessively check it, eventually turning it off because they want to manage it better. They end up investing less. I've seen automation-oriented investors swear they'll do it manually, then invest twice in 6 months and give up because it feels like too much work. The product doesn't determine success. Your self-awareness does.
Here's what all of this actually means for your wealth. Let's say you invest $5,000 today. VTSAX or VTI, doesn't matter which. Same holdings, same returns. 30 years from now, assuming 7% real returns, that's $38,000. Now let's say you spend 3 months deciding. You invest the same $5,000, but 3 months later, market goes up 2% in that time. 30 years later, you have $37,200. You lost $800 by waiting. But here's the bigger picture. It's not about this one decision. It's about the pattern. If you're the type of person who spends 3 months deciding between index funds and ETFs, you're probably also spending time deciding which broker to use, what allocation to choose, when to rebalance, whether to invest more during corrections, whether to switch strategies. Each decision costs time. Each delay costs compounding. Meanwhile, the investor who picked one and moved on has been compounding for years. Not because they're smarter, because they valued action over optimization. This is the real secret wealthy investors know. Perfect is the enemy of good, and good done consistently for 30 years becomes excellent. The difference between VTSAX and VTI over 30 years, assuming you invest the same amounts at the same times, may be a few $100s, rounding error. The difference between investing consistently for 30 years versus starting 3 years late because you were optimizing, tens of thousands of dollars. That's the asymmetry. Tiny product differences, massive behavior differences. Okay, let's make this concrete. Choose VTSAX if you have at least $3,000 to start, you want to set up automatic monthly investments, you plan to stay at Vanguard long-term, you prefer systems over manual decisions, you're in a taxable account and value portability. Choose VTI if you're starting with less than $3,000, you want the flexibility to invest varying amounts, you might switch brokers in the future, you prefer maintaining control over timing, you're in a taxable account and value portability. That's it. No other considerations matter enough to affect your decision. But here's the most important part. Both are correct. You cannot make a wrong choice between these two. The wrong choice is not choosing at all. The wrong choice is spending another week researching expense ratios that differ by 0.01%. The wrong choice is waiting for the perfect moment or the optimal strategy, because while you're waiting, the market is compounding without you, and you can't get that time back. So here's the difference nobody explains. It's not about tax efficiency, it's not about bid-ask spreads, it's not about fractional shares. It's about which structure matches your psychology well enough that you'll actually use it for 30 years. That's the only difference that compounds. VTSAX compounds your behavior if you need automation. VTI compounds your behavior if you need control. The product is just the vehicle. Your consistency is the engine. And here's what I want you to understand. Whichever one you choose, the hard part comes later, not the decision, the staying invested part. Because 3 years from now, the market will drop 20%. Your account will be down. You'll feel stupid for investing at all. That's when the difference between success and failure reveals itself, not in which ticker symbol you chose, in whether you kept buying. 7 years from now, your account will have doubled. Your friends will be talking about crypto or AI stocks or whatever the hot thing is. You'll feel boring. That's another test. Not product selection, discipline. 15 years from now, you'll have more money than you ever imagined, but it will have felt slow the entire time, boring, unremarkable. That's the final test. Can you stay invested when nothing exciting is happening? Because that's what actually builds wealth, not picking the optimal fund, staying invested through the optimal fund, doing its boring, reliable thing for decades. So, make your choice, today, right now. Do you need automation? VTSAX. Do you need control? VTI. Then take the next 30 years and forget you made a choice. Just keep investing, keep compounding, keep ignoring the noise. Because the investors who win aren't the ones who optimized the decision. They're the ones who made a decision and then focused on what actually matters. Consistent action over decades. That's the difference nobody explains. Not between index funds and ETFs, between people who build wealth and people who study it. If this changed how you think about investing, hit the like button and subscribe. More videos like this coming. Real talk about what actually moves the needle in building wealth. No hype, no complexity, just what works. Now go open your account and buy something. You've spent enough time thinking about it. The market is waiting, and it rewards action, not analysis.